Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Since it's flat for the equity markets, it gives us some time to ponder over what's happening in the currency space. Manisha Gupta is here to give us a quick round check on all of that. Hi Manisha, good morning.
Morning, Sonia. Thank you so much for that. Well, we have the crude oil prices actually trading flat. It is a bit of a divergent when you see the Brent crude oil prices are trading flat to slightly negative, but the US crude is trading nearly 0.3% on the higher side. So the Indian market's clearly taking cues from Brent right now, and we are trading at flat moves there. We have seen gains in the overnight market. It is about the Iran sanctions that the markets or the prices have really reacted to. It also has to do with the fact that the US energy product inventories have continued to decline. They hold at a 4-year lows ahead of an important seasonal demand period there, and that would keep the prices in check, in support, that is. From here on, the markets do believe that we perhaps have seen a near-term bottom, and there could be some consolidation, even some gains coming in from these levels. The decline in the US dollar has been a reason that we have seen the metal prices gain up. Today is the third straight day that you have the precious metals trading in the positive. So gold and silver both off those 1-year lows that we were trading in the previous year. The US president has shown a displeasure on the US Fed interest rate hikes, and that perhaps has worked well for the bullion markets here. The base metal prices also have continued to have it good. We have seen copper prices continue to move away from 1-year lows. It actually is trading at a 1-week highs now, and we have seen $6,000 per ton come back on LME. The copper prices in the Indian markets also have made a very strong support at around 400 to 405 level marks, and we have seen constant gains from there. Aluminum anyway continues to be in flavor because China is talking about cutting output there ahead of winters. We have seen strong gains come in for steel and its ingredient. Remember, the steel rebar prices are trading at a 7-year highs, and the hot rolled coil is trading at an all-time highs in China, and that clearly is impacting those steel ingredients. So you have nickel prices continue to gain up. Zinc has been surging higher as well, and lead, because of that battery demand coming back into the markets, has been yet another reason that you have seen strength. In any case, remember, the metals have been oversold, so it is a bit of a short squeeze rally coming in, and there is also bargain buying on the lower side that we have seen in that space. And then again, you have the US-China conversation happening in this week, and markets are anticipating something positive from there. Trading strategies, we have them from Grow Value. It's a buy call in the precious metal space. For silver, they're looking at upside targets of 38,000 today. For gold as well, they expect buying to continue. 30,250 is on their charts.
Okay, thank you very much for all those details, Manisha. Well, the markets, that is the equity market at this point in time, once again in flat trade, a little bit of green as well on the mid-cap space. 1:1 as far as advanced declines are concerned. The market's just settling down to flat terrain at this point. So let's present you with another big voice from corporate India. Ajay Piramal says he is open to an acquisition of a big domestic pharma company at reasonable valuations as his non-compete clause with Abbott expires in September. Piramal is looking for a niche play when it comes to the export market and is also eyeing smaller OTC targets to grow his pharma business. Ajay, of course, has been always very big on pharma. Our colleague Nisha Podar caught up with Ajay Piramal, and let's listen to a slice of the very interesting chat.
If we find that there are businesses that we can acquire which will have a long-term value creation potential and which we can get at a reasonable valuation, we will definitely do that. So we are examining it, but we have not come to any definite term potential in it.
And how much of your kitty would you set aside for any such inorganic growth in pharma?
So I don't think funding is a constraint, so it depends on the opportunity. Right. If we think it's worthwhile, then we will adequately fund it.
Mr. Piramal, you know it better than me that Indian pharma companies have been saddled by not just pricing pressure but also US FDA concerns. Some of them have succession issues as well, and management bandwidth is also lacking in some of them. Do you think that some of those big pharma companies or sizable pharma companies also, they will be also on your radar?
The gains and the advantages that Indian pharma in the export had for generic exports is no longer there. That's why if you look at our own strategy of pharma has always been to get niche, complex products for export. But for the simple generic oral solid dosage products, I think that market is highly competitive and not so profitable. So that's not something we are looking at. We would look at the domestic, and if there are even larger companies that want to exit out, I mean, we are open to that.
Okay, and what about the valuations currently? Even though the markets fell and the overall performance of the companies came down, a lot of investors say that in terms of valuations, the market capitalization of most of the pharma companies which are struggling is still on the higher level. What do you have to say about that?
Yeah, so rather than be, this is a very general statement, but yes, there are some valuations which are high. That's the challenge when we have to, when we are looking at acquiring. Unless and until we find that there is a reasonable valuation or a valuation that we think in the long term we can create significant value, only then would we invest in.
You have looked at several assets, several OTC brands, but you have always found the valuations unattractive. How are they poised right?
So we have actually done acquisitions in OTC. We have not done the really mega acquisitions, but we have been growing OTC. What we're doing in OTC is actually what we did in the domestic market earlier. We are building on our sales, we are building on our distribution, so that we have the pipe ready for introducing new products, and we could introduce products either through our own development, which we are doing, or through acquisition of smaller products.
So you talked about the focus in the retail space when it comes to home finance. Of course, a large part of your portfolio was in the real estate funding, over 80%. Now it's come below 75%. Now this migration to more retail focus than wholesale, you know, that hasn't gone down well when it comes to the profitability angle. So is it a temporary phenomena? How do you see the profitability bit panning out?
The net interest margin in any housing portfolio would be lower, but the costs have also come down to some extent. Secondly, I think again, because of housing, we can get a higher debt equity ratio. So our returns on equity, which is what is really key for us, will again come back to the levels that we are aiming for, which is 20%.
How risky is the book when it comes to the real estate funding segment?
First of all, as I said, in real estate alone, we understand that business probably better than most people who lend in that space are. Besides that, we have what we call early warning signals. So we keep monitoring projects in a close manner on a monthly basis. We have this last nuclear option, which people think, we've never exercised it, is that people will know that if they default, then we can take it over and actually develop it ourselves.
One of the nicer points about the rally of the last 1 week has been the participation of the broader market, and Anuj has been pointing that out for the past couple of days. Month to date, for the month of August itself, the mid-cap index has risen by about 3.8 to 4%, while the Nifty itself is up 1.8%, so quite clearly indicating the outperformance of the mid-cap index, or at least ending its underperformance. So is it a time to look at small-cap, mid-cap funds yet again? For these and other questions, Tahir Badshah, CIO Equities of Invesco Mutual Fund, joins us now. Good morning, Tahir. Thank you very much. It's always a pleasure having you with us. What would your answer be to that question? Is it time to once again start buying mid-cap, small-cap funds?
So yeah, I mean, I think compared to the situation what was about 6 months ago, at the end of calendar year 2017, when mid caps and small caps were on a roll, I think the main deterrent was basically valuations, and at that point in time, valuations were completely untouchable. Since then, we've seen a fairly decent amount of correction in the mid-cap and the small-cap space. The index itself has corrected quite meaningfully, and then individual stocks have done even more so. So I think now at least we are in a position to assess some of the companies that we liked earlier but were unable to buy. We think they're not cheap, but at least they are kind of getting a lot more reasonable than what they were earlier. And I think to that extent, therefore, there is a little greater comfort in buying some of these names. We have also added to our portfolio names in wherever we found things attractive. So I think it's a good time for one to kind of build gradually. It is not something which you can start buying now and hope for returns immediately in the next 6 months. But I think the next few months in the volatility, in the run-up maybe to the elections and few other global volatilities, I think we'll get a fairly decent chance to build a position in the mid and small cap space for an eventual return target of 2-3 years and beyond. So anecdotally too, we have seen that typically mid caps and small caps are best are bought when they are a little more reasonable. Even people who bought mid caps in 2014, even today they are making returns. So I think if you buy them reasonable, then there is a fairly decent chance that you will do well with the mid and small cap space and yet avoid the volatility associated with it.
Oh, absolutely. I mean, if you look at your fund, the Invesco India Mid Cap Fund, so many of the stocks there, Exide, MRF, United Breweries, Balkrishna have all done exceptionally well. Tahir, good morning and greetings of the season to you. Eid Mubarak to you and your entire team at Invesco. I wanted to talk a little more about the auto ancillary space. Thank you. About the auto ancillary space, because here you have, Balkrishna, MRF, Exide, etc. Chola Mandalam Investment as well. Some of the NBFCs catering to this space. You think there's a lot more potential here?
Well, I would think so, in the sense that, we of course have seen some of these stocks do brilliantly well for us in the recent past. We like them at least still for their businesses. Maybe the valuations have kind of gone up a couple of notches in the last few months. But these are all kind of individually picked. There is no one common theme across all these names if you were to see. By and large, we've tried to do, at least as far as some of the auto ancillaries go, is to ensure that they are not necessarily as affected directly by EVs and the threat of EVs and so on. So basically, therefore, the focus on things like tires or batteries and such. There is a certain amount of overlay in terms of ensuring that we get some currency-related tailwind as well. So export-oriented companies have probably been preferred from that perspective. So I think it's a carefully chosen kind of approach. It's significantly bottom-up driven. There are some common themes which are running around it, but largely more bottom-up. So I would think that they have done a pretty good run in the recent past, but yet they continue to attract us from the point of view of their business configuration, and therefore they figure amongst our top holdings.
Your carefully chosen bottom-up set of stocks doesn't have a single cement stock. You're not bullish on that space?
So we're still concerned about supply additions running well ahead of industry demand overall, and that's something which is constraining us from looking at this sector very constructively. We have seen some stocks, especially in the mid-cap cement space, even correct. So maybe there will be a point where we will probably find them attractive. They are cyclicals ultimately at the end of the day, so we need to make sure that if the outlook for either prices or costs is not very clear, then at least from a valuation perspective, they need to be very, very reasonable so as to, then we are running with lesser amount of risk. So we are happy to look at it, we are monitoring it, but they are still to come to a stage where, we can kind of override the uncertainties around the business by the valuations that they offer us. So that's the balance that we are trying to strike in cement.
Okay, so that's about cement, but you don't have any pharma exposure either in the top 10 holdings in any of your fund. And this is a space that has done the best this month. I mean, some of these stocks like Dr. Reddy's, Sun Pharma are all up about 10-15% this month. You think this is a trading rally at best?
Well, so pharma is still evolving. We still feel that it is work in progress kind of sector in a way, and a few things are falling into place, but not all of it. When we analyze, while the headline numbers in some of the large companies which have reported, and even some of the mid-sized names have been pretty good compared to the previous few quarters, but the internals don't look as strong, and vulnerability remains with respect to pricing going forward, as well as uncertainty around new product launches. So what we have done basically, while of course you're right in pointing out that we don't have pharma exposures in the top 10 in the funds, but we do have a decent footprint amongst some of the other names. we've tried to look at, healthcare ancillaries. We've tried to look at some which are a lot more domestic oriented and maybe a little more reasonable in terms of valuation. So if you go down the portfolio, you will find a few pharma names. Yes, we don't still have the confidence and gumption to buy them with 7-8% kind of exposures. So we are still awaiting that situation to arise or that combination to come about. So we'll wait for that.
Okay. Tahir, today we had discussions with some investors who have actually started to look at real estate sector. Would you do that? It's been beaten down so much. Is it finally finding a bottom? Will there be any space for it in your funds?
So we've evaluated a couple of names. We still have to make up our minds, or we're still not fully convinced. Maybe there are other ways to play it, those who are kind of proxies to real estate in a way. So we're trying to explore those as well. But still, the return on capital and for many of these companies, or even directionally in terms of their overall business footprint, the variability across different regions is so vast that it's difficult to come to grips. There's not a uniform product or a single product which is sold at one price across the country, as you know. So it's difficult to kind of get your arms around it unless you buy a very focused regional player. And then it has its own challenges because then you're narrowly focused. So we are kind of still yet to find a good idea in this space as yet.
Okay. Well, I also want to ask you about finance. You have Cholamandalam, IndusInd Bank, City Union Bank and RBL Bank. Not the usual insurance, housing finance, not of interest to you?
So insurance, we've kind of valuations at one level are not understood. Valuations at another level appear to be very, very optically expensive. So to that extent, we find it difficult to buy. We found it difficult to buy some of these names, even though we like some of those businesses. But we are kind of constrained. We've focused a little bit on general insurance, which has kind of given us returns. But even there, now valuations are becoming a little bit of a challenge. So that's why the play around NBFCs has largely been focused around things which are to do with autos as a segment or consumer finance as a segment, okay. Which is where there is greater visibility. Okay. Of course, there too now valuations have become a little bit of a challenge, but nonetheless, I think that's what we find it better.
All right. Okay. Consumption has dominated our discussion today. Thank you very much, Tahir, for joining us. Have a great Eid and a great year ahead.
Okay, well, we'll wrap up Bazaar on that note, but lots of stock ideas coming up. Tech Mahindra is now your big gainer. Bank of America Merrill Lynch has upgraded that stock. If you